Big news today.
Ooh.
Argentina just crushed Peru in soccer.
Wow.
It's got me thinking.
Yeah.
Do even events like that have any impact on things like, say, our taxes?
Right.
Well, today's deep dive is all about getting you up to speed on Pakistan's tax laws,
Okay.
using the Income Tax Ordinance 2001 as our roadmap.
Okay.
But don't worry,
Oh.
we're going for the need-to-know version, not a law school lecture.
Sounds good.
We also have a little news snippet from Business Recorder just to keep things interesting.
Okay.
Ready to dive in?
Absolutely. The ordinance is a pretty hefty document.
I bet.
But we can definitely break down the key points for you.
Perfect. So first things first.
Okay.
What's the big picture here? What's this ordinance all about?
Basically, the Income Tax Ordinance 2001 is the rule book for how Pakistan's income tax system works.
Okay.
It's divided into chapters and sections, kind of like a giant detailed recipe book for taxes.
Okay.
And just like a recipe book gets updated with new and improved versions. Right.
This ordinance has seen a lot of amendments over the years.
Amendments. Yeah.
Wow. Amendments.
Which shows just how much detail goes into keeping it up to date.
That already sounds more complex than my grandma's secret biryani recipe. So tell me, what kind of ingredients are we talking about here? What kinds of income does this ordinance actually cover?
Pretty much everything you can imagine.
Really?
Your regular paycheck, any money you make from investments,
Okay.
profits from businesses, even income from property, it's all covered in meticulous detail.
Okay, so they've got it all laid out.
Yeah.
But wouldn't that make filing taxes a total nightmare?
Right.
Imagine having to look up a separate rule for every little thing you earned.
Well, that's where the concept of tax deduction at source comes in.
Oh,
TDS, it's like having a little bit of tax taken care of
Okay.
before you even get your hands on the money.
I see.
Think of it as a prepayment system.
So they take out some tax before I even see the money.
Exactly.
Is that like when they deduct for insurance and stuff from my paycheck?
Exactly. It's a way to simplify things
Right.
and ensure a steady stream of tax revenue throughout the year.
Okay, that makes sense.
Yeah.
But what kinds of payments are subject to this TDS?
It applies to a wide range of things.
Such as?
Your salary, for instance, is subject to TDS.
Uh-huh.
And so are dividends from your investments,
Yeah.
even payments to people outside of Pakistan or for things like rent
Rent.
are covered.
Wow, they really have thought of everything, haven't they?
They try to.
But it can't be all about taking money away.
Right.
Are there any breaks in the system at all?
Of course.
Oh, good.
The ordinance also has provisions for things like tax credits and exemptions.
Okay,
These can actually reduce your overall tax liability.
I like that.
Think of them as rewards for doing certain things the government wants to encourage.
Rewards for good behavior, huh?
Right.
I like that. Tell me more about these credits and exemptions.
Okay. What kind of things are we talking about?
Well, one example is charitable donations.
Donations.
If you donate to a registered charity, you can actually claim a tax credit for that.
Okay.
It's a way to encourage people to give back to the community,
I see.
and it can benefit you come tax time.
Wait, so if I donate to charity, I pay less tax.
It can, yes.
That's actually pretty clever.
Yeah,
It encourages people to be generous while still collecting revenue.
exactly.
What other good deeds can get me a tax break?
Another example is investment in new industrial undertaking.
New industrial undertakings.
The government wants to boost economic growth.
Right.
So if you invest in certain types of new businesses,
Okay.
you can get a tax break for that too,
Interesting. So it's not just about collecting money.
right?
It's also about using the tax system to steer people towards actions that benefit the whole country.
Exactly.
Okay. So far, we've been talking about people living and working in Pakistan.
Uh-huh.
But what about people who aren't actually residents?
Okay. How does the ordinance deal with them?
That's a great question.
Thanks.
The ordinance distinguishes between resident and non-resident taxpayers.
I see.
There are specific rules for figuring out who falls into which category,
Okay.
and it can significantly affect how much tax someone pays.
So just being a Pakistani citizen living abroad doesn't automatically mean you're off the hook for taxes back home.
Not necessarily. It all depends on various factors, like how long you've been living abroad and whether you're considered a tax resident of another country.
Okay, this is definitely getting more complex than I imagined.
Yeah.
Now, there's this term minimum tax
Okay.
that I keep seeing in the ordinance.
Right.
It sounds a little scary.
Yeah.
What's that all about?
Minimum tax is an interesting concept.
Okay.
It's a way to ensure that certain individuals and companies, even if their taxable income is low,
Okay.
still contribute a minimum amount to the tax system.
I see.
It's kind of like a safety net for tax revenue.
So even if you're claiming losses, you might still have to pay something.
It's possible, yes.
Who does this minimum tax actually apply to?
It mainly applies to specific sectors like banking, insurance,
Okay.
and oil and gas exploration.
Okay.
You know, industries that are generally thought of as big earners,
Right.
even if they don't always declare huge profits.
So it's a way to make sure those big players are contributing their fair share.
Exactly.
Even if their accountants get creative with the numbers.
Right.
Pretty smart.
Yeah.
Now, I have to ask,
Okay.
what happens if you just plain forget to pay your taxes on time?
Well, the ordinance has a provision for that too.
Oh, no.
It's called a default surcharge.
Default surcharge.
Think of it like a late fee for your taxes.
A late fee.
Yeah.
So it's like when I forget to return my library books on time.
You could say that.
Except probably a lot more expensive, right?
Yes. Haha.
Okay.
The surcharge is calculated as a percentage of the unpaid tax.
Okay.
And it keeps adding up every day
Every day.
until you pay what you owe.
Ouch.
Yeah.
So no escaping those taxes.
Not really.
Not even with a big soccer win.
Speaking of soccer wins.
Oh, yeah.
Yeah.
Hold on. Did you see that news from Business Recorder?
No. What was that?
Looks like Argentina pulled off a major victory.
Wow.
I wonder if a win like that could ever have any impact on Pakistan's tax laws.
Oh. As exciting as that victory is,
Right.
I highly doubt it would directly affect the tax code.
Okay. Probably wishful thinking on my part. But you know what this does highlight?
What's that?
Even though we're talking about the nitty-gritty details of tax laws, these things exist within the context of everything else that's happening in the world.
Right.
Soccer matches, political changes,
Yeah.
economic ups and downs,
Absolutely.
and they touch every single one of our lives.
They do.
Do you think knowing all this could actually help our listener out in the real world?
Oh, definitely.
I mean, aside from winning trivia night at the pub, we've already talked about how the ordinance, because there's all sorts of income from your salary
Yeah.
to investments and even property.
Right.
And don't forget those tax credits and exemptions,
Of course.
which can really make a difference come tax time.
Exactly.
Plus, we've touched on how resident and non-resident taxpayers are treated differently.
Yeah.
And those potential pitfalls,
Right.
like the minimum tax
Yeah.
and those pesky default surcharges.
Exactly.
That's some crucial stuff.
It is.
If we connect this to the bigger picture, we're talking about real world implications for our listener, right?
Exactly.
This knowledge could help them make smarter choices about their finances.
Yeah.
Whether it's about investing,
Right.
donated to charity, or even just understanding their paycheck deductions.
Absolutely.
And maybe even avoid those default surcharges.
Exactly.
Okay, that's all starting to make a lot more sense. Now, I'm curious about how some of these different types of income are actually defined within the ordinance.
Okay.
Let's start with something everyone's familiar with.
Okay.
Salaries.
Salaries, right?
What exactly is salary, according to the taxman?
That's a great question.
Thanks.
And the ordinance is very specific about this.
Okay.
It's not just about your base pay.
Oh,
It goes much deeper than that.
so there's more to it than meets the eye.
There is.
This is where it gets really interesting.
It does. Section 14 of the ordinance outlines everything that falls under the definition of salary for tax purposes.
Section 14. Okay.
It includes things like wages,
Okay.
annuities, pensions,
Yep.
and even gratuities.
Okay, that makes sense.
Yeah,
But there has to be more to it, right?
there is.
What about things like bonuses or commissions? Do those count as salary too?
Absolutely.
Okay.
The ordinance is very comprehensive.
Okay.
It also includes things like fees,
Fees.
commissions, perquisites.
Wait, perquisites.
Yeah.
What are those?
Perquisites, or perks, as they're commonly called,
Perks, okay.
are those non-cash benefits you might get from your employer.
So perks, like,
Yeah,
is that like when your boss lets you borrow the company car for the weekend?
you got it.
Okay.
Think company cars,
Okay.
housing allowances,
Right.
even club memberships.
Oh, wow.
And yes, those are factored into the tax calculation too.
So those perks aren't really free after all.
Right.
But how do they put a value on those things for tax purposes? I mean, a company car could be a beat up old clunker
Right.
or a fancy sports car.
You're right. That can get a bit tricky.
Yeah.
But the ordinance has clear guidelines for valuing perquisites.
Okay.
The general rule is to use the fair market value.
It's fair market value.
Basically, what you would pay for those benefits if you were buying them yourself.
Okay, that seems fair.
Yeah.
But what if the employer is paying directly for those perks? Like covering your gym membership fees. How does that work?
In those cases, the amount the employer pays is generally considered the value of the perquisite for tax purposes.
So it's all about being transparent
Yeah.
and making sure the true value of those perks is accounted for.
Precisely.
Okay.
And the ordinance goes into even more detail about how to value specific types of perquisites, like housing allowances. There are detailed calculations
Oh, wow.
based on the type of accommodation and your salary.
Wow, it really does get into the nitty gritty.
It does.
So they've got those traditional perks covered.
Right?
But what about those employee stock options you hear about all the time,
Yeah.
especially in the tech world?
Excellent point.
Thanks.
Employee stock options are becoming increasingly popular as a way to compensate employees,
Okay.
especially in certain industries.
Uh-huh.
And the ordinance has specific rules for how those are taxed.
Okay, spill the beans.
Yeah.
How do they figure out how much tax you owe on those stock options?
Well, the key thing to remember is that the tax isn't applied when you're granted the options.
Oh.
It's when you actually exercise those options and buy the shares.
I see. Okay.
Yeah.
So you only pay tax when you actually make money from the shares.
Exactly.
Okay.
And the tax is calculated based on the difference between the price you paid for the shares when you exercise your options and the market value of those shares at that time.
Okay.
So if the share price has gone up since you were granted the options,
Okay.
that profit becomes taxable income.
That makes sense.
Yeah.
But what if you hold on to those shares for a while
Okay.
and then sell them later on?
Yeah.
Do you have to pay tax again when you sell them?
Yes, you do.
Oh, really?
Any profit you make from selling those shares is also considered taxable income.
So they tax you on the initial gain when you exercise the options.
All right.
And then again on any profit you make when you sell the shares.
Exactly.
Okay.
The ordinance covers both scenarios. To ensure a comprehensive approach to taxing income from employee stock options.
Wow. They really have thought of everything.
We've tried to.
I'm starting to see why this ordinance is so long and detailed.
It's pretty extensive.
Okay, so we've covered salaries in detail.
Okay.
Now let's move on to another type of income
Okay.
that's a bit more. Well, let's just say it might apply if you're doing pretty well for yourself.
Okay.
Dividends.
Dividends.
A great choice. Dividends are definitely an important part of the income picture.
They are.
And Section 5, the ordinance, lays out all the rules for how they're taxed.
Okay.
All right, hit me with the details. What do we need to know about how dividends are taxed in Pakistan?
The main point is that dividends received in Pakistan are taxed at a specific rate.
Okay.
And that rate is outlined in a separate part of the ordinance called the first schedule.
First schedule.
Think of the first schedule as a giant appendix
Okay.
where all the specific numbers and rates are kept.
Okay, so the tax rate for dividends can actually change
It can?
depending on what's in this first schedule.
Yes.
It is.
Yeah, right.
The ordinance provides the framework,
Okay.
but those finer details can be adjusted based on various factors and government policies.
Interesting.
Yeah.
So does this tax on dividends apply to every single dividend you receive?
There are actually some exceptions.
Oh.
For example,
Okay.
if a company has already paid tax on its profits,
Right.
and then it distributes those profits as dividends,
Okay.
those dividends might not be taxed again.
Ah,
It's a
okay.
way to avoid double taxation.
Ah, that makes sense.
Yeah,
Wouldn't be fair to tax the same money twice.
right.
So, are there any other quirks about how this tax on dividends is calculated? Anything else we should know?
Well, the tax is calculated on the gross amount of the dividend,
Gross amount.
meaning before any expenses or deductions.
So, no subtracting expenses before calculating the tax.
That's right.
Okay.
But remember,
There might have been tax already deducted at the source when you received those dividends.
right, that TDS we talked about earlier.
Exactly.
So even though the tax is calculated on the gross amount,
Yeah,
you might have already paid a chunk of it up front.
exactly.
It's all connected.
It is.
And understanding how all these pieces fit together
Yeah,
is key to understanding Pakistan's tax system.
absolutely.
Okay, dividends, check. Now let's tackle another interesting category.
All right.
Profit on debt.
Profit on debt. Okay.
Is this just about the interest you earn from your savings account?
It's broader than that.
Okay.
Section 7 of the ordinance covers profit on bet.
Section 7.
And it's not just about your typical bank interest. It includes any interest,
Okay.
discount premium,
Okay.
or other benefits you get from a debt obligation.
Okay, so we're talking about a wider range of scenarios here.
Right.
Things like bonds,
Right.
loans between individuals, all of that could fall under this profit on debt umbrella.
Precisely.
Okay.
The ordinance is designed to cover a wide range of financial transactions.
So how is a tax on this profit on debt actually calculated? Is it similar to dividends?
Yes, the calculation is quite similar.
Okay.
The tax is calculated by applying a specific rate to the gross amount of the profit on debt.
Gross amount again.
Yes.
No deductions up front.
Right.
And we also need to remember the tax deduction at source might have already been applied.
Absolutely.
It's all about understanding the interconnectedness of these different elements.
Exactly.
This is also fascinating.
Yeah.
The level of detail in this ordinance is impressive.
It is a detailed document.
They really have thought of everything, haven't they?
They certainly have.
And we've only just scratched the surface.
Right.
There's a lot more to uncover.
A lot more.
Okay, I'm ready for more. Let's dive into another category.
Okay.
What about royalties?
Royalties.
I know authors and musicians get those, but what exactly are they and how are they taxed?
Royalty income is another area
Okay.
that's covered extensively in the ordinance.
Okay.
And it's particularly relevant for anyone involved in intellectual property.
Okay.
Think authors,
Authors, right?
musicians,
Yeah.
inventors, even software developers.
Okay, so we're not just talking about book royalties here.
Right.
It's a broader concept.
It is.
What's the main point about how they're taxed?
Well, Section 6 of the ordinance
Section six.
states that any royalty received in Pakistan is subject to tax.
Okay.
And just like with dividends and profit on debt, the specific tax rate is outlined in the first schedule.
First scheduled again.
So that rate can fluctuate.
Okay, that's becoming a familiar pattern now.
Yeah.
But what exactly counts as royalty under the ordinance? It seems like a pretty broad term.
You're right. It is a broad term.
Okay.
Royalty includes payments you get
Okay.
for the use of copyrights,
Copyright.
trademarks, designs, even secret formulas or processes.
Wow. So we're talking about a wide range of intellectual property rights.
Exactly.
The ordinance aims to capture all the ways in which someone might profit from using intellectual property within Pakistan.
Right.
This is also interesting. It's like peeking behind the curtain of the financial world.
I like that analogy.
Okay, so how is the tax on these royalties actually calculated? Is it similar to the previous types of income we talked about?
You're catching on quickly.
Thanks.
Yes, the calculation is similar.
Okay.
The tax is determined by applying the relevant rate from the first schedule to the gross amount of the royalty.
Gross amount, there it is again.
Yeah.
And of course, we need to factor in any tax that's already been deducted at the source.
Precisely.
It's like a puzzle. And each piece fits together.
Exactly.
I'm really enjoying this deep dive into the ordinance.
Yeah.
It's like cracking a code. But I'm curious about those non-resident individuals again. Are there any special rules for them when it comes to royalty income?
There are.
Okay, what are they?
And this is where it gets a bit more nuanced. The ordinance provides certain exemptions for non-residents when it comes to royalties.
Okay.
For example,
Right.
if the royalty income is linked to a permanent establishment they have in Pakistan, it might be exempt from tax.
So if they're already running a business in Pakistan
Yeah.
and the royalty income is part of that,
Right.
they might not have to pay separate taxes on it.
That's the idea.
Okay.
It's about streamlining things and avoiding double taxation.
Okay, that makes sense.
Yeah.
Are there any other situations where a non-resident might be exempt from paying tax on royalty income?
Yes, there is one more.
Okay, what is it?
If the royalty income is already exempt from tax under some other provision of the ordinance,
Okay.
then Section 6 doesn't apply.
So there are multiple layers of rules and exceptions
There are.
to ensure fairness and avoid unnecessary taxation.
Exactly.
Okay.
The ordinance is designed to strike a balance
Okay.
between generating revenue for the government and creating a supportive environment for both individuals and businesses.
This is all really eye-opening.
Yeah.
As we're going through these different types of income,
Okay.
it's interesting to see how the ordinance seems to anticipate potential loopholes and address them head on.
Absolutely.
The ordinances have been developed and refined over many years,
Yeah.
taking into account various scenarios and potential challenges. It's like they've thought of everything.
They've tried to.
But I have one more question about this royalty section.
Okay.
It mentions something called fees for technical services.
Right.
Alongside royalties.
Yeah.
What's the connection there?
That's a great observation.
Thanks.
The ordinance actually treats fees for technical services in a very similar way to royalties.
Oh.
In fact, Section 6 explicitly includes them within its scope.
So does that mean those fees are subject to the same tax rates and calculations as royalties?
That's right. Okay.
The ordinance recognizes the value of technical expertise
Okay.
and wants to ensure that individuals and businesses providing those services in Pakistan are contributing to the tax system.
Okay. That makes sense.
Yeah.
But what exactly are fees for technical services under the ordinance? Is there a specific definition for that?
There is.
Okay. What is it?
The ordinance defines fees for technical services as any payments received for things like managerial,
Okay.
technical or consultancy services.
So it's not just about hands-on technical work.
Right.
It also covers those higher level roles that require specialized knowledge.
Exactly.
Okay.
The ordinance takes a broad approach to encompass a wide range of expertise that might be provided in Pakistan.
This is really helpful.
Good.
So if I'm understanding correctly,
if a non-resident individual comes to Pakistan to provide some kind of consultancy service, any fees they receive for those services would be treated just like royalty income for tax purposes.
That's correct.
Okay.
And remember those exemptions we discussed earlier for non-residents?
Yeah.
Those would apply to fees for technical services as well.
So if the services are linked to a business they already have in Pakistan, or if those fees are already exempt under some other part of the ordinance, they wouldn't be taxed under Section 6.
Precisely.
Okay.
The ordinance strives to create a balanced system that considers different scenarios and prevents double taxation.
This deep dive is really shedding light on the intricacies of the ordinance.
Yeah.
It's fascinating to see how much thought has gone into creating this whole system.
It is quite impressive.
It is.
Yeah.
But speaking of impressive, there's one more thing in this section that caught my eye. It mentions something called fee for offshore digital services. That sounds pretty modern and high tech.
You're right.
Okay.
That's a relatively new addition to the ordinance, reflecting how much our world has changed with the rise of the digital economy.
Okay, I'm intrigued.
Okay.
Tell me more about these fees for offshore digital services.
Okay.
What are they exactly, and how are they taxed?
Essentially, fees for offshore digital services are payments received by someone outside of Pakistan for providing digital services to someone in Pakistan without actually having a physical presence in Pakistan.
So we're talking about services delivered entirely online.
Exactly.
Okay.
Like software subscriptions or online advertising.
Think about things like subscribing to a streaming service.
Right.
Using online design tools.
Right.
Or even taking an online course from an instructor overseas.
Exactly.
Okay.
Those could all fall under this category.
Wow, that's a huge and growing part of the economy these days.
It is.
It makes sense that the ordinance would address it specifically.
It does. What's fascinating here is how the ordinance tackles income from property.
Okay, income from property. Now that's something I think everyone can relate to. It seems pretty straightforward, right? You own a property.
Yeah.
You rent it out. You pay taxes on the rent you collect.
Right.
End of story.
Well, not quite. Section 15 of the ordinance is all about income from property.
Section 15.
And it's a bit more nuanced than just collecting rent checks.
Okay, I'm sensing a but coming. What's the catch? What else do we need to know about this income from property business?
The key thing is that the annual value of the property is what's considered taxable income.
Annual value.
Not just the rent you actually receive.
Hold on. Annual value. What does that mean exactly?
Think of it as the potential rent your property could generate in a year, even if you're not currently renting it out.
Wait, so even if my apartment is sitting empty,
right,
I could still be taxed on what it could be rented for?
It's possible.
That doesn't seem very fair.
I understand where you're coming from. But the ordinance recognizes that property has inherent value.
Okay.
Even if it's not actively generating rental income at a given time.
Okay.
It's like saying, hey, you own this valuable asset, so there's a potential for income there.
Okay.
And we need to account for that in the tax system.
Okay, I guess that makes sense from a taxman's perspective.
Yeah.
But how do they actually figure out this annual value.
Right.
It can't just be a random number they pull out of a hat, can it?
You're right. It's not arbitrary.
Okay.
The ordinance has specific guidelines for determining the annual value.
Okay.
They look at things like the size and location of the property, its condition, and what similar properties in the area are renting for.
So they're doing their research, not just throwing darts at a board.
Yeah, right.
It's good to know.
Yeah.
But owning a property isn't all sunshine and roses, is it?
Right.
There are expenses involved.
Of course.
Like repairs, maintenance, property taxes.
Right.
Do those factor into the tax calculation?
Absolutely.
Okay, good.
The ordinance recognizes that owning property comes with responsibilities and costs.
Right.
Section 15 allows for certain deductions to account for those expenses.
Okay, that's a relief.
Yeah.
So what kind of deductions are we talking about here? Can I deduct for every little thing that goes wrong with the property?
No, not every little thing.
Oh, okay.
But you can deduct things like municipal taxes you paid on the property.
Okay.
And there's also a deduction for repairs and insurance premiums.
So the ordinance takes into account the fact that maintaining a property costs money.
Yeah.
That makes the whole system seem a bit fairer.
Exactly.
Okay.
The goal is to ensure that you're only taxed on the actual net income you derive from the property after those legitimate expenses are taken into account.
Okay. That's starting to make a lot of sense.
Good.
But I'm always thinking about those potential loopholes. Are there any safeguards in place to prevent people from claiming crazy deductions
Right.
and dodging their tax obligations?
That's a sharp observation.
Thanks.
You're right.
Yeah.
The ordinance has to be airtight to prevent abuse.
Right.
For example.
Okay.
There are limits on how much you can deduct for repairs.
Okay.
And any major upgrades or improvements you make to the property.
Okay.
Those capital expenditures can't be deducted all at once.
So you can't just go on a renovation spree and write it all off as a business expense.
Exactly. It's about being fair and ensuring that the deductions you claim reflect genuine costs associated with maintaining the property, not inflating expenses to avoid taxes.
Okay, so we've got those solo property owners covered. But what happens if a property is owned jointly by multiple people?
Right.
How does the ordinance handle that? Let's say you and I go in on that beachfront condo together.
Okay.
How do we figure out our taxes?
Great question.
Thanks.
The ordinance has specific rules for joint ownership in those cases.
Yeah.
The income from the property is split among the owners.
Good.
Based on their share of ownership.
So if you and I each own half of that beachfront condo, we each only pay tax on half of the rental income.
Precisely.
Okay.
And the same principle applies to deductions.
Okay.
Each owner can deduct their share of the expenses based on their ownership percentage.
That makes perfect sense.
Yeah.
It would be a nightmare trying to figure out the taxes if one person had to pay for everything.
Right.
But only owned a tiny share of the property.
Exactly.
Okay, I think I'm starting to get a good grasp on this income from property business.
Good.
It's more complex than I initially thought.
It can be.
But the ordinance seems to have all the angles covered.
It does.
We've talked about this mysterious first schedule a few times now.
Yeah.
It seems like it holds a lot of important information.
It does.
Can we dive into that a little deeper?
Absolutely. The first schedule is like the key to unlocking the specifics of the ordinance.
Yep.
It's where all the detailed rates and rules
Okay.
for different types of income and deductions
Right.
are laid out.
Okay, so it's like the appendix of the tax code.
Yeah.
The place you go to look up the specific numbers.
Yeah.
So what's in this first schedule?
Okay.
How is it organized?
It's divided into 4 parts,
4-part.
each dealing with a different aspect of the tax system.
Okay.
Part I focuses on the rates of income tax for individuals and companies.
Part I. Okay.
Yeah.
So if I want to know exactly what percentage of my income I need to pay in taxes,
Right.
Part I is where I'd find that information.
Exactly.
Okay.
It's where the specific numbers we keep referring to
Right.
are actually listed.
Okay, that makes sense.
Yeah.
What about the other parts of the first schedule? What kind of goodies are hidden in there?
Well, part 2 is dedicated to the rates of tax for companies.
Part 2, companies.
Well, part 3 outlines the rates for tax deduction at source.
Okay.
You know, that TDS we keep talking about.
Right, TDS.
And finally,
Okay.
part 4 covers the rates for different types of advance tax.
Wow, it's like a treasure trove of tax information.
It is pretty detailed.
I'm starting to see why this first schedule is so crucial for actually understanding how the ordinance works in practice.
Right.
It's like having the answers to all the test questions.
That's a great way to put it.
Thanks.
The ordinance provides the general framework.
All right.
The big picture.
Okay.
But the first schedule fills in all the crucial details.
Okay.
The specific numbers and rates that determine your actual tax liability.
Okay, so it's a two-part system.
You got it.
The ordinance sets the stage.
Yeah.
And the first schedule provides the specific instructions. I like it.
Yeah.
It's like having the rule book and the cheat sheet all in one.
Right, exactly.
And that's why it's so important to always refer to the first schedule.
Yeah.
When you're trying to figure out a specific tax provision.
Absolutely.
So, for example, if we're trying to calculate the tax on those dividends we talked about earlier,
right,
we need to consult the first schedule to find the exact tax rate.
Precisely.
Okay.
And the same goes for figuring out the tax deduction rate on payments to non-residents.
Right.
It's all laid out in the first schedule.
This is so helpful.
Good.
I'm starting to feel a lot more confident about navigating this whole ordinance thing.
Good.
It's like we're putting together a giant jigsaw puzzle. And the first schedule is the picture on the box.
Right.
That helps us see how all the pieces fit together.
That's a great analogy. It's all about understanding the system and how the different parts connect.
Okay, let's put our newfound knowledge to the test. Remember how we were talking about the difference between resident and non-resident taxpayers?
Yes.
That seems like a pretty important distinction.
It is.
Right. So let's say we have a non-resident individual coming to Pakistan to work on a short-term project.
Okay.
Maybe providing some technical expertise.
All right.
How would we figure out their tax situation?
First things first.
Okay.
We'd have to consult Section 84 of the Ordinance.
Section 84.
Which lays out all the rules for determining residency status.
Okay.
We need to make sure this individual actually qualifies as a non-resident under the ordinance.
Okay, so we check the rule book to make sure they fit the definition.
Right.
What's the next step?
Then we need to figure out the specific tax rate that applies to their income from those technical services.
Okay.
Remember, we talked about how those fees are treated similarly to royalties?
Right.
Yeah.
So we'd head over to the first schedule, specifically Division 8 of Part 1, to find the exact tax rate for that type of income.
You got it.
Okay.
And then we'd apply that rate to the gross amount of the fees they receive for those services.
And of course, we can't forget about the potential for tax deduction at source.
Right.
We need to check Part 3 of the first schedule to see if any of those rules apply in this case.
Exactly. It's like a multi-step process.
Right.
But once you understand the steps, it's not that intimidating.
This is amazing.
Yeah.
We're like tax detectives, piecing together all the clues from the ordinance and the first schedule.
Right.
It is quite satisfying, isn't it?
It is.
I feel like we're finally starting to crack the code of the Income Tax Ordinance 2001.
We're definitely making progress.
But there's always more to uncover.
Always more to uncover.
Speaking of uncovering more, there's one more concept I want to make sure we touch on.
Okay.
Minimum tax.
Minimum tax.
We talked about it briefly earlier, but I think it deserves a bit more attention.
You're absolutely right.
Yeah.
Minimum tax is a unique aspect of the ordinance.
Okay.
And it's designed to ensure certain individuals and companies contribute their fair share, even if their taxable income is below a certain level.
Okay, remind me again.
Yeah.
Who does this minimum tax apply to?
It primarily targets individuals and companies in specific sectors, like banking, insurance, and oil and gas exploration.
Those industries that are often seen as having high earning potential.
Right.
Even if their declared income doesn't always reflect that.
Precisely.
Okay.
Minimum tax acts as a safeguard,
right,
ensuring that these individuals and companies contribute a minimum amount to the tax revenue.
I see.
Regardless of their declared income.
So even if a company is reporting losses, they could still be liable for minimum tax.
That's right.
Okay.
And it's not calculated based on their income,
but
rather on factors like their turnover.
Or the value of their assets.
So even if their accountants are working overtime to minimize their declared income, they can't escape this minimum tax.
Exactly.
Clever. This really highlights how much thought have gone into crafting this ordinance.
It does.
It's not just about collecting taxes. It's about creating a fair and balanced system.
That's a great observation.
Thanks.
The ordinance is designed to be robust and adaptable,
right?
Addressing a wide range of scenarios and potential loopholes.
As we're exploring these different provisions, it's becoming clear that the Income Tax Ordinance 2001 is much more than just a dry set of rules.
Yeah.
It's actually a reflection of Pakistan's economic landscape.
Right.
And its evolving priorities.
That's an excellent point.
Thanks.
The ordinance is a living document.
Okay.
It's constantly evolving to reflect the changing realities of the economy.
All right.
Just like we saw with the addition of those provisions for fees for offshore digital services.
Exactly.
And the minimum tax provisions.
Yeah.
Highlight the government's focus on ensuring a fair contribution from key sectors.
Exactly.
Okay, before we go any further down this fascinating rabbit hole,
okay,
let's take a step back and remind our listener why all of this matters to them.
A great idea.
It's easy to get lost in the intricacies.
Right.
But ultimately, this deep dive is all about empowering our listener with knowledge and insights that they can actually use.
Exactly.
Right. So, listener, as we wrap up this part of our exploration, remember this. Even though the Income Tax Ordinance 2001 might seem intimidating at first glance, understanding its key provisions can give you a real advantage.
It's about knowing your rights.
Right.
Understanding your obligations and making informed decisions about your finances.
Exactly. And who knows? Maybe this deep dive has sparked a newfound curiosity about the world of taxes.
It's definitely possible.
It's certainly opened my eyes to how much there is to learn.
There's always more to discover.
And in the final part of our deep dive, we'll explore those differences between resident and non-resident taxpayers in more detail. Plus, we'll unravel the mysteries of those default surcharges. And the potential penalties for not playing by the rules.
What's fascinating here is how the Income Tax Ordinance 2001 distinguishes between resident and non-resident taxpayers.
Yeah, it's not as simple as just looking at your passport. It's about understanding where your economic interests really lie.
Exactly.
We touched on this earlier, but I think it's worth a deeper dive. Especially since it can make a big difference in how much tax someone ends up paying.
Absolutely. Let's take another look at sections 83 and 84 of the ordinance, which spell out the specific rules for figuring out who's a resident and who's not for tax purposes.
Okay, let's start with those folks who are considered resident individuals. What are the key things that determine whether you fall into that category?
Well, the most straightforward rule is based on how much time you spend in Pakistan. If you're physically present in the country for 183 days or more in a tax year, you're generally considered a resident for tax purposes.
So if you're spending more than half the year in Pakistan, the tax man considers you a local. Simple enough. But are there any other situations where you might be considered a resident taxpayer? Even if you haven't been in Pakistan for that full 183 days?
There are. The ordinance recognizes that residency isn't just about your presence in the current year. Your ties to Pakistan in previous years can also matter.
Okay, so even if I haven't spent 183 days in Pakistan this year, my trips back home in previous years could still come into play.
They could.
How does that work?
If you've been in Pakistan for a total of 365 days or more over the 4 years leading up to the current tax year.
And you're in Pakistan for at least 90 days during the current year, you could still be considered a resident.
I see.
It's like they're looking for a pattern of connection to the country.
So even if you're spending most of your time abroad, those frequent trips back home could tip the scales and make you a resident taxpayer in Pakistan.
Exactly.
That's interesting. Are there any other scenarios that might trigger this resident status, even if you're not physically in Pakistan for most of the year?
There's one more important provision to keep in mind. If you're a Pakistani citizen, and you're not considered a tax resident of any other country, you'll automatically be considered a resident of Pakistan for tax purposes.
Whoa. So even if you've been living abroad for years, your Pakistani citizenship could still make you liable for taxes back home.
It could.
That's something every Pakistani living abroad needs to be aware of.
Absolutely.
It's crucial to understand these rules.
And potentially seek professional advice.
To
make sure you're filing your taxes correctly, wherever you might be living.
For sure.
Okay, so we've covered those resident individuals.
Right.
Now let's switch gears and talk about companies.
Companies, okay.
How does the ordinance define residency for them? It can't just be about where their headquarters are located, right?
Yeah, right.
Okay.
It's a bit more complex than that.
Okay.
Section 83 of the ordinance outlines 3 main ways a company can be considered a resident of Pakistan for tax purposes.
Okay, I'm ready.
All right.
Break it down for me.
The first criterion is pretty straightforward.
Okay.
If a company is legally established in Pakistan, incorporated or formed under Pakistani law, it's automatically considered a resident company.
Makes sense. If it's born and raised in Pakistan, it's a resident for tax purposes.
Right.
What's the next rule?
The second one focuses on where the company's decisions are made. If the control and management of the company's affairs happen entirely in Pakistan, then it's considered a resident company.
I see.
Even if it's registered somewhere else.
So even if a company is technically incorporated in another country,
right?
If the big decisions are being made in a boardroom in Pakistan, they're treated as a resident for tax purposes.
Exactly.
That's really interesting. It's not just about the paperwork,
right,
but also about where the real power lies.
Exactly.
Okay.
The ordinance recognizes that a company's residence isn't just about its legal address. It's about where the core operations and decision-making are happening.
That's a smart approach.
Yeah.
Okay, so what's the third way a company can be considered a resident in Pakistan?
The third criterion is pretty straightforward.
Okay.
Any provincial or local government in Pakistan is automatically considered a resident company for tax purposes.
Okay, that makes sense.
Yeah.
Governments definitely have a significant presence in Pakistan.
They do?
So to recap, a company can be considered a resident if it's incorporated in Pakistan,
right,
if it's managed and controlled from Pakistan, or if it's a government entity.
Precisely.
Wow. Okay.
The ordinance covers all the bases.
Okay, so we've talked about all these different scenarios for both individuals and companies.
Yeah.
But why does all of this residency stuff even matter? What difference does it make for the average person or business?
It matters a lot.
Okay.
Your residency status is like a key that unlocks different sets of tax rules.
Okay.
It affects things like the tax rates that apply to your income, the deductions and exemptions you might be eligible for.
Okay.
And even whether you're subject to withholding tax.
So knowing whether you're considered a resident or non-resident is like choosing the right path through a complex maze.
Taking the wrong path could lead to some unpleasant surprises.
That's a great analogy.
Thanks.
Being misclassified could mean paying more tax than you should.
Oh.
Missing out on potential tax savings. Or even facing penalties.
Okay. That's definitely something to keep in mind.
Yeah.
Now let's switch gears and talk about something that no one likes to think about.
Okay.
But is important to understand.
Okay.
Those default surcharges.
Default surcharge.
What happens if you accidentally miss a tax payment deadline? Do you get thrown in tax jail?
Well, hopefully not.
Okay.
But the ordinance does have clear consequences for late payments.
Okay.
Section 205 outlines the rules for those default surcharges.
Okay.
Which are essentially penalties for not paying your taxes on time.
Okay, so these default surcharges are like a late fee on your taxes.
Right.
But how much are we talking about here? What's the damage if you miss a deadline?
It's not a fixed fee.
Okay.
The surcharge is calculated as a percentage of the unpaid tax amount.
And the longer you wait to pay, the more that surcharge adds up. It's like a ticking time bomb.
Yikes. So procrastination can really cost you.
It can.
When it comes to taxes.
Yeah.
What's the actual percentage used to calculate this surcharge?
Currently, it's 12% per year.
12% per year.
Or KIBOR plus 3%.
KIBOR.
Yeah.
Refresh our listeners' memory on what that means.
Sure. KIBOR stands for Karachi Interbank Offered Rate.
Okay.
It's basically the average interest rate that banks use when lending money to each other.
Okay, so the default surcharge rate is linked to this benchmark interest rate. Which can go up or down depending on the economy.
Right.
That makes it a bit unpredictable, doesn't it?
It does.
It means the surcharge could be higher or lower.
Yeah.
Depending on what's happening in the financial markets.
Right.
So if you're thinking about putting off paying your taxes, remember that this surcharge could make it much more expensive than you anticipate. That's good advice. It's not worth playing chicken with the tax man. And I think you mentioned that this surcharge isn't the only thing you have to worry about.
Right.
If you're late with your payments.
You're right.
Okay.
Default surcharges are just one piece of the puzzle.
Oh, dear.
You could also be charged interest on the unpaid tax amount.
Okay.
And there's even the possibility of additional penalties.
Penalties on top of the surcharge and interest.
Yeah.
Okay, now I'm really starting to sweat. What kind of penalties are we talking about?
The penalties vary.
Okay.
Depending on the specific violation, for example.
Okay.
There are penalties for not filing your tax returns on time.
Right.
For providing false information.
Okay.
Or for intentionally trying to evade taxes.
So it's not just about being late with your payments.
Right.
It's about following all the rules and regulations laid out in the ordinance.
Exactly.
Right.
The penalties are there to encourage compliance and make sure everyone is playing by the rules.
Well, we've covered a lot of ground today.
We have.
From defining all those different types of income.
Yeah.
And exploring those tricky residency rules to understanding the consequences of late payments.
Right.
We've really done a deep dive
into
the Income Tax Ordinance 2001.
It's been a fascinating journey.
It has. And I hope our listener feels a lot more informed and equipped to navigate the world of taxes in Pakistan.
That's the goal.
Knowledge is power.
It is.
When it comes to your finances.
Absolutely.
But listener, remember, this deep dive is just a starting point.
Right.
The Income Tax Ordinance 2001 is a complex document.
Is.
And everyone's situation is unique.
Absolutely.
So if you have any doubts or specific questions, the best advice is to consult with a qualified tax professional.
Couldn't agree more.
They can help you make sure you're dotting all your I's and crossing all your T's.
For sure.
And with that, we've reached the end of our deep dive. Thanks for joining us on this journey into the world of Pakistan's income tax laws.
It's been a pleasure.
We'll catch you next time on the deep dive, where we'll explore another fascinating topic.
Okay.
And help you uncover even more hidden knowledge.